you can see we could have, from where price is today, we could have about a 5% rally into the end of the year over the next week or two. So that's at this point, that's the upside potential, and kind of ideally what we'd love to see. Anyways, last but not least, let's take a look at the big weekly chart of the S&P 500. Now, this is our technical trader strategy. This kind of tells us when the market is, in a bullish environment, moving up with green bars. It allows us to avoid big bear market sell-offs. Today we are seeing the precious metals and the dollar starting to move together. So the dollar index, if we take a look, is having a bit of a bounce. Again, we talked about this yesterday. It's got that Fibonacci measured move, and it hit that 100% measured move here, and now it's having a little bit of a bounce. Now, precious metals are on fire today, moving higher. We've got gold up 0.7%, which isn't huge, but it is moving up, and it is trying to break out of this euphoric phase where everybody seemed to pile in who was going to get into the space, and then they got hammered. We end up seeing the market hit our target here where we got out for a 15% gain. This was the FOMO squeeze, the blow off top, and now it is shaking people out, and it's on the verge of breaking out and starting that run to potentially $5,200 per ounce. Now, silver is up big today. It's up 4%, having a big move. Again, it pulled back 4% a couple days ago. And of course, it was nothing but conspiracy theories and all kinds of crazy stuff of manipulation, which I believe was just a margin requirement. And people are always stretching their margin. So it just was a forced selling type of day. Today's up 4%. I'm sure there's going to be no manipulation talk there. It'll be, no, this is the way it should move. So I don't get caught up in that stuff. I'd be very cautious with that mindset because it can really ruin the experience of trading. Everything is manipulated in some way. You just have to roll with it, and you don't know what or when. So just accept price action for what it is, and your trading will be a lot cleaner, a lot more enjoyable, and probably more profitable because you won't be picking tops or thinking manipulation is screwing you over all the time.
Gold's advance has been steady, not explosive, but that may be its greatest strength. After a euphoric rush earlier in the cycle flushed out late buyers, gold has quietly stabilized and is now threatening another breakout. Silver, meanwhile, is doing what it always does during emotional phases, exaggerating the move. Sharp pullbacks followed by sudden rallies are common in silver, often driven by leverage and forced selling rather than fundamentals. These violent swings are less about conspiracy and more about positioning. Price action, not emotion, remains the most reliable guide.
Take a look at platinum and palladium, both up almost 4% this morning. We're seeing platinum really start to scream and pick up to the upside. If we look at palladium, up 3.5%. The whole precious metal space is starting to come to life today, so it's breaking out to some highs here. And I have not looked at gold miners yet, but let's take a look at GDX. GDX, it broke out. It pulled back a little bit with the stock market fading down into this high here. So again, it still looks, everything has got these series of the stair-stepping action, which is a series of bull flags pointing still to higher prices going forward. And it looks like we can see the market closed right here yesterday for GDX, and it is trading up at the high from yesterday's high. So we are seeing GDX trade up about 1.7% this morning. Silver miners most likely up as well. So let's just take a quick look at SILJ, SILJ. And it is trading up about 1.7% as well. So the precious metal space is coming to life today, which is no surprise. It's just a matter of letting this trend and these bull flag patterns mature and have their series of rallies and pauses to try and shake things up and get people worried and concerned before it goes higher. Now we are seeing the energy space come to life as well. Natural gas up 3%, very oversold. It has had a swan dive, and if we take a look at the price action, it's just having a little bit of a bounce. This at this point is a dead cat bounce, which means it's just oversold. It's a technical bounce, and be a little bit of short covering, and be a little bit of bargain hunting, bottom pickers. You can't trust this. This is picking a bottom. It might have a big bounce, who knows, but it's just an oversold bounce at this point.
This rally isn't limited to gold and silver. Platinum and palladium are joining the move, signaling renewed interest across the entire precious metals complex. When multiple metals advance together, it often suggests a rotation into hard assets rather than isolated speculation. Mining stocks are confirming the trend, climbing despite broader equity volatility. The pattern is familiar, a staircase of rallies and pauses, shaking out weak hands before resuming higher. These consolidations are not failures, they are how sustainable trends are built. Patience, not prediction, is what this phase demands.
If we take a look at crude oil, that's up 1.8% this morning. Now, yesterday I talked about how it came right down to these lows. Just zoom back here. Came right down into this low area, and how I said it would probably try to find some last little bounce or pause before breaking down. Now, it did pierce it and closed, it did, pierce those lows. But overall, it's not always just a pierce and a tick that creates a breakdown. We'll want to see it definitely clearly close below it. I wouldn't be surprised if this bounce or trades sideways for a session or two, but then if it rolls over and closes definitively below this level here, around $55 per barrel, we could really go and see a pretty sharp, precipitous drop that we could see down to about $45 per barrel if this was to unwind. So we'll see how that unfolds again today. Equities are trading a little bit higher this morning. Yesterday, we started to see some panic selling in the market, which we can really see with our little panic selling indicator here. If I just stretch this out, we can see late in the session, we started to see the fear or panic selling index spike up, end up closing in the above this blue line, above 3 yesterday. Typically, we see the market put in a significant low, and the market started to rally from that. So overall, we saw a multiple series of sell-offs throughout the day. If we just look at yesterday's trading session with the S&P 500, and I stretch this out, you can see it's a series of waves of, you get a bout of selling of fear, and then there's a little bit of bounce and bargain buying, and then we get another bout of selling, and then another bout of selling. And so this is where the market kind of went into, excuse me, a oversold kind of panic selling phase. And then from there, we started to see accumulation. We saw the on-balance volume more or less trading flat or sideways. And then after we saw that panic selling, the panic selling indicator started to move higher. So overall, some interesting price action. Now, this is very, very short-term stuff, but it gives us a good insight of kind of where we are. And I talked about how yesterday the market really needs to find some support here for this trend to stay intact and keep moving higher.
While metals heat up, energy markets are telling a more cautious story. Natural gas is rebounding after a brutal sell-off, but the move appears technical rather than structural, a classic oversold bounce. Crude oil is more consequential. Prices are hovering near critical support, where markets often pause before deciding direction. A failure to hold could open the door to a sharp decline, reflecting slowing global demand and tightening financial conditions. Energy prices frequently act as an economic signal, and right now that signal is flashing uncertainty rather than confidence.
Now, if we take a look over at the NASDAQ, we'll look at the QQQ. Very similar price action, although it traded more sideways through the day. If we actually just zoom out to yesterday, it really actually just kind of traded sideways for most of the session and then ended up having a nice little bit of a squeeze up into the short squeeze into the close. And today we are set to see the markets open about 1/3% higher. Now, we do have some price spikes on the charts. If we take a look here, we've got a price spike. Let me just get rid of this volume by price indicator. We've got a price spike to the downside here. I think we have that in the SPY as well. So let's just take a look at SPY. Usually that means we're going to see the markets have a little bit of a pullback. There we go. If we take a look at the, so we do have here's a price spike to the downside. So it's already hit the first target. It's hard to see right here. There's a little blue line. There's a 33%, 50%, and 100% of that spike. So we might see the market still move down and want to come back to where it ended up closing for the session, or maybe even dipping a little bit down. But overall, the market is trying to carve out a bottom. It has not only gone to lime green on our 30-minute chart, which is an oversold price level, but we also have panic selling, which means price is also somewhat oversold from a panic standpoint. This one, the lime green, is based on price moving too far, too fast, and the green one is people's emotions getting stretched too far, too fast. and they're panicking, and usually that becomes a turning point for the market. If we take a look at the daily chart, you can see this is generally seen as a strong candle. The market gaps lower, it flushes down, it rallies back up and holds its ground for the day. This usually can be seen as a bottoming, a reversal type of candle. We had one kind of over here, we had one over here as well. They happen all over the place, but typically after it's happened with a sell-off, we've got a rise in volume telling us that fear and panic is rising. The VIX has been moving up. All that can signal potentially a standout low. So with any luck, we're going to see the end of the year holiday rally. We see the equities market come back up to these highs, potentially even run higher.
Equities recently experienced a wave of panic selling, visible in volatility spikes and rapid intraday declines. These moments often feel chaotic, but they are also how markets reset. Selling came in waves, followed by hesitant bargain buying, classic late-stage fear behavior. Volume patterns suggest distribution gave way to accumulation, at least temporarily. On short-term charts, conditions reached oversold extremes both in price and investor emotion. Historically, that combination creates conditions for reflexive rallies, even if longer-term risks remain unresolved.
And if we were to look at it using Fibonacci extension, there is potential for a pretty decent move to the upside. If we just take a look at the price action, you could see we could have, from where price is today, we could have about a 5% rally into the end of the year over the next week or two. So that's at this point, that's the upside potential, and kind of ideally what we'd love to see. Anyways, last but not least, let's take a look at the big weekly chart of the S&P 500. Now, this is our technical trader strategy. This kind of tells us when the market is, in a bullish environment, moving up with green bars. It allows us to avoid big bear market sell-offs. It also moves us to cash and protects us when the market has some extreme mixed signals, because you never know which one of these sections here are going to turn into a big bad bear market. So you always have to protect your capital. You can always get back in later with a click of a button, but you can't always make your money back with a click of a button. Usually it takes time. And so we don't want to waste time. That's why we move out, we step aside, we wait, and we get back in once the market picks back up. Now, when we look at 2022, we went into this bear market phase, and we were talking about how this was very close. If this was to roll over, we would have gone into a massive, massive sell-off. And we were able to avoid it. Our strategy got us out up near the highs and got us back in after it found a bottom. We got to avoid that 20+% crash or little baby bear market. This scenario right here is very similar to the scenario kind of like right here or like right over here. Again, we are very close to a precipitous type of meltdown and crash. Of course, the governments and the systems are always throwing in things to try to save the day, kick the can down the road, juice the markets. And that's what we keep seeing here. But eventually, they're not going to be able to stop it. Once the landslide starts and the whole world gets nervous and starts selling, one government, I don't think, is going to be able to save the market with even, it doesn't matter, cutting rates and throwing money at the market. When the whole world starts selling, they just cannot afford to buy up everyone's selling pressure globally.
Zooming out, the market sits uncomfortably close to a tipping point. Long-term trend models show conditions similar to past moments that preceded major declines, periods when markets appeared stable until they suddenly weren't. Policy interventions have repeatedly delayed reckoning, but confidence is harder to manufacture than liquidity. When global selling becomes synchronized, even aggressive stimulus can fail to stop momentum. That's why capital preservation matters as much as opportunity. You can always re-enter a market, but recovering lost capital is far more difficult when fear takes control.